We're going to look at Verde, Agritech, NPK on the TSX. You talked about them a couple times, I believe, in the past, at least one.
Yep.
This stock price had surged. We looked at the valuations then and ahead of the guidance. They'd come out with guidance and just not hit, as far
Yep.
as I recall, on the business. And, that's one thing we look for if management's going to issue guidance. We're going to give them a check mark or a plus if they hit it. If they miss it, they're going to get a negative. If you continue to miss your guidance, which this company clearly has, I think we've seen, it becomes, at some point, it becomes a no-fly zone for us unless there's a significant change and you've had a significant hit of that guidance over time.
Yeah, we'll get into it. So, like Ryan said, the last time that I covered the stock was as a dog in April of 2023, after the stock was down 50% because management ended up cutting guidance. And we ended up getting a question from Rob via email on whether we believe the stock offers value at its current price. So, Verde Agritech Ltd, or NPK on the TSX, currently trades at a price of about $2.39 with about $126 million market cap. They're an agricultural company which produces and sells fertilizers in Brazil and internationally under the K-Fort, Bax, and Super Green Sand brand names. As well, it holds a 100% interest in the Cerrado Verde project, which is the source of potassium silicate rock, and that's in Brazil. Now, the company is currently permitted to mine about 2.8 million tons per year and has manufacturing capacity through its Plant 1 and Plant 2 for a combined 3 million tons per year. And they're looking to expand this further with a new mine pit, which they're pending permit approval right now, as well as an additional plant number 3, which could provide production capacity of up to 10 million tons per year. But this is just at the pre-feasibility stage. Now, as I said before, on March 30th of 2023, the company lowered its fiscal 2023 guidance from 2 million tons of fertilizer sold to a range of 800,000 to 1.2 million. And this is what they stated. They say, potash trends did not meet the market's expectations after the Ukraine war. The price of potash has been on a downward trend since late 2022, with a 67% decrease over the past year and a sharp 22% decline in the first 3 months of 2023, leading farmers to hold back potash purchases with expectations of even lower prices in the future. So those farmers are, delaying their purchases as they too expect, potash prices to come down, which is essentially why we saw, management revise lower. However, looking at their Q2 2023 results, the company's tons sold were down to about 107,000 tons, with total revenue of 10.3 million, which was down 59%. EBITDA was down 80% to 2.1 million, and net profit was also down substantially to 241,000. And of course, the primary reason for the decline in sales was both the decline in tons sold, which I said, farmers weren't demanding as much, as well as the decline in price of potassium chloride. And on top of this, there was also a decline in the USD, which depreciated, or US dollar, which depreciated by 10% against the Brazilian real. Now, looking to see, how the company's year-to-date 2023 results are looking in comparison with the 2023 guidance. Well, Verde has sold about 215 million tons so far, meaning they will need to sell over 585 million tons in the second half of the year to meet the bottom range of their targeted 800 million ton guidance. Now, on what I have up on the screen here, you can see they generated about 21.4 million in revenue year to date, meaning, again, they will need to double this to about 56 million in the second half of the year to meet their target. And if we look at profitability, they're about halfway there to meet their EBITDA target, but their EPS target or guidance is lagging, where they just did a quarter of a penny in the first half of the year, which is still a ways off of the bottom end of 4 cents per share that they're guiding towards. And just because it is showing on the slide here, this is just a note. The additional, years after 2023, or you can see the projected revenue here. This is including the pre-feasibility study plant 3 scenarios where they either do 10 million tons per year, 23 million tons per year, or 50 million tons per year. But the bottom line is, it appears that the company is, behind this guidance, that they've even revised lower. So moving on, I just quickly wanted to show this here. This is from the company's MD&A of the average potassium chloride spot price in US dollars. So again, we can see why the company's results have been under pressure as the price for potash has came down significantly. And lastly, just on the balance sheet, the company has about 6.2 million in cash and equivalents, with debt of about 38.4 million, bearing interest at 16.4% per annum right now, which is quite high, of course. If we do include the leases that they have, the company has a Q2 2023 annualized. So I'm annualizing the most recent quarter EBITDA. They have a annualized net debt to EBITDA multiple of about 4 times, which again is also quite elevated. However, the business has noted in their investor presentation that they would like to aggressively pay this down, and they expect to end the 2023 year with debt of about 29 million rather than the 38 million that they had on June 30th of 2023. So my takeaway here is pretty simple. Verde is an interesting business with a path of growth ahead of it. It trades at 4.6 times the midpoint of its forward EBITDA guidance and at just 14.5 times the midpoint of its EPS guidance. However, so far in 2023, it appears the business may struggle to even achieve the bottom end of its guidance. Now, I cannot blame management, as it is extremely difficult to gauge the forward financials of a business when its operations are extremely reliant on a volatile commodity, which happens to have collapsed from its highs just after the outbreak of the Ukraine war. And like I was saying, reduced farmer demand as they anticipate paying lower prices in the future. Now, the good thing is the company has shown that they can produce profits even in a bad market or a tough market. But given their elevated debt levels and high interest rate, along with the anticipation to further expand capacity with the Plant 3 production scenario, which will cost an initial capex of about 53 million US, at this time, it is tough to fathom how they will fund such a venture without going to the market to raise equity and dilute current shareholders or take on more debt when they're already quite leveraged. Now, in August, management did indicate that the agricultural market is showing early signs of a recovery, but with tough comparable financial results due to a tumble in the price of potash, reduced demand from farmers, all while having a levered balance sheet and appearing to be behind on all fronts of achieving the low end of their guidance. It is not a stock we would recommend at this time and continue to monitor. Now, maybe they will put up an absolute phenomenal second half of the year. But right now, looking at they've been reducing their guidance. Now it looks like they're behind it. We wouldn't cross our fingers that there's going to be a blowout or anything in the second half of the year.
Right. And like any of these commodity sensitive companies, whenever they put out guidance, that's always conditional on their estimate of commodity prices, average commodity prices for the year,
Mm-hmm.
which is really just an estimate. I mean, they don't know any more than anybody else. And, you could even make the argument that their projections can be worse because they're so psychologically biased towards, wanting to see positive indications. But this is really the issue. I remember answering some questions from investors on this company when the earnings were really high, the valuations were so low, and the questions from investors were centered around, well, isn't this a no-brainer, right? Like, do you not just load up on this? And the answer is like, but it's, you don't know what the commodity price is going to be, so it's a commodity. No stock is ever a no-brainer, particularly a commodity price sensitive stock.
Yeah. Exactly. And, on that point where you're saying, they're making assumptions. So yeah, for their guidance, they are using an average KCI CFR price or potash, which is US $405. So, you can see we're already below that essentially in as of July. I think that we might be slightly nudging up to that 400 again, but still, that is an assumption, a big assumption that they've made.
Yeah, well, often, and Aaron touched on this, my take would be when you have a commodity-based business, when your forecasts depend on a volatile underlying commodity, companies either don't give guidance on revenues or they give a significant range on revenues and profitability, because it's just so difficult to forecast that. You end up, if it runs against you, the commodity price, you're over promising and under delivering, and then you get punished over the long term. You don't end up with a market or an analyst community or investor community that is confident in your forecast, so they become meaningless over time. I would suggest, if you want to do that, either give a range or just relate your guidance to production. Just have it all based on your production growth over time, which is something that you can control more than you can control the pricing of the commodity. So hopefully, that would be something that this company can do, and we can track that, because you're always going to have the volatility. I'm constantly doing this on these companies on the podcast, but that's the way it goes. It's very difficult to forecast even within a range. That's what I would suggest for a company or any commodity related business for that matter. Or else you look like a company you look like a hero if it goes for you, right? But the next year you can look like an absolute zero. And this company, has gone from 10 to 2, basically, because of a commodity decline. And, they're saying, well, we thought everything would go up following the war in the Ukraine. It's very uncertain. Those type of events, basing your forecast or even the world forecast on something like that type of global event, it's just so difficult to do. And forecasts in that respect were dead wrong. So,
yeah, exactly. It was almost like we got a lot of people wanting us to look at Nutrien and a lot of these potash companies following the war in Ukraine, because everybody was like, this is a no-brainer. Potash prices are elevated and they're here to stay. Well, it's not always a no-brainer. Like one example that I quote a lot from The Intelligent Investor by Benjamin Graham and Warren Buffett is just airline stocks. Airline stocks were, most people in the market were like, this is a no-brainer. Air travel, this is awesome. Well, airline stocks kind of were a little bit of a dud because of the logistics and fuel and the volatile nature of fuel prices and everything that they had to deal with. So even though something does look like a no-brainer, it might not be. So just keep that in mind.
Yeah, and as Nutrien, for an example, good company, but in March of 2022, in that range, it was the $130, $129 range. It's 83 today. They're affected by the underlying price of the commodity. And we had many clients then at the start of the war, announcements around that. We've got to get into those. It immediately adjusted, but then, over time, boom, and the stock price has done poorly because the price hasn't gone just to the moon like everybody thinks it will in that moment, and you end up with a poor investment. So the underlying commodity is very volatile, very difficult to predict. That's why those companies often look cheap, because nobody will, the market learns over time. Sophisticated investors learn over time that you can't pay a premium valuation for a company that has very fluctuative earnings.
Mm-hmm.